Good afternoon, everybody. Thanks for taking the time today. I know everybody's busy. I hope everybody's staying safe and staying healthy. This is the second webinar series of Whalen University. We would usually host these at a specific location or at our office, but because of everything that's going on with the pandemic, we decided to take it virtual, much like the rest of the world. And this is a topic that I'm actually very excited to go over, which is disruptive technology. We get asked a lot, how do we build individual equity positions in the portfolios? Why do we have specific names, specifically in our focus equity portfolios that the large majority of clients attending this webinar actually hold inside of their portfolio? And it all comes down to, looking towards the future. And, I use specific companies as examples of dinosaur companies who've, kind of stayed their track over their life cycles. And unfortunately, sometimes their stocks have underperformed. But when we focus on investing, we really are committed to a growth style of investing for our clients. And we believe the best way to uncover and evaluate such companies is through intensive, fundamental, and sometimes proprietary investment research. We believe that companies that are undergoing what we call positive dynamic change offer the best investment opportunities. And by positive dynamic change, we mean those companies experiencing either high unit volume growth or positive life cycle changes. So high unit volume growth can be defined as something like rapidly growing demand, strong business models, or even a market dominance. And positive lifestyle or life cycle changes can be either new management, product innovation, M&A or restructuring, or even new regulations that allow companies to take advantage of kind of the landscape that we're involved in. And before we jump into the disruptive technology, I just want to remind everybody of a couple of upcoming webinars that we do have. The first one is going to be August 12th. That is our halftime report. So typically we hold these at country clubs where we're basically going to look at where we're at so far this year in the economy and where we think the market and the economy is going to be for the remainder half of this year. So make sure you tune into that one. That's August 12th. And then August 26th is another passion project of mine. Where we actually have interviews with various medical professionals, biochemists, as well as engineers that talk about what the future is going to look like in their opinion and why thinking further in a portfolio, much like looking at disruptive technology, is going to be very beneficial to clients over the next 15 and 20 years. So that's going to be August 26th. But without further ado, let's start this disruptive technologies and advances that are really changing the world in our opinion. And we started talking about kind of the focus equity portfolio. And when we look at building individual positions, not only do we want to own the best and the brightest in different industries, but we want to look at those companies that are either experiencing high unit volume growth or positive life cycle changes. And for the most of you, some of the top holdings in the portfolio, which consist of names like Amazon, Microsoft, Apple, Visa, Facebook, Alibaba, Alphabet, which is Google, T-Mobile, and Adobe. Between those about 10 names, that makes up about 52% of the portfolio. But what we're going to focus on a little bit more today is the other 50% of the portfolio and how those individual positions can really potentially bolster the portfolio over a life cycle of investing by looking at things like disruptive technology. So as you look through your individual portfolios, I'm going to name some names that may be in there and why we own those because of what we see in this landscape of investing over the next 5 and 10 years. And one thing that I'd like to point out before we really get into it is what COVID is going to do to the world at a minimum level. And at a minimum level, what COVID has done, it has accelerated the timeline to a digital landscape economy. So if we thought companies like Amazon, as an example, were going to crush brick and mortar over a 10 or 15-year life cycle, that's really been accelerated maybe 5 to 10 years instead of 10 to 15, because once consumers' behaviors change, it's really hard to alter back to where they were prior to what COVID was. So we want to be able to take advantage of investing in some of those names and some of those areas within clients' portfolios. So when we're talking about disruptive technology, it's one that really displaces an established technology and shakes up an industry, or it's a groundbreaking product that creates, a completely new industry. So if we think about internet services and kind of what they've disrupted in the past, this is what this slide really goes over. Online shopping really disrupted brick and mortar. That started in the late 90s, early 2000s, and really accelerated over the last 7 or 8 years. Email has disrupted the US Post Office. Online news has disrupted newspaper and even evening news, where people are getting a lot of their news directly from their mobile devices. Streaming music really put a lot of pressure on record companies and retail sales. If anybody remembers Tower Records, that was one of the largest retail record companies in the United States. They were basically put out of business by iTunes. Streaming and TV movies are affecting cable companies as well as advertising, right? So we talk about this when we look at names that are involved in social media, not just for the addictive technology that they provide, but also the ad revenue, because that's where the eyeballs are. Think of like a billboard driving. You may get a discount on putting, an advertisement up on a billboard, but 9 times out of 10, the passengers are focused on their phones, and even 50% of the time, some of the drivers are actually, which leads to, many number of problems. But and COVID is going to impact both the streaming TV and movie segment as more production companies and studios look to deliver content on demand. That's why you may see, some problems potentially with some of the movie chain theaters. But that's a disruptive technology, as well as social media. So social media, at a minimum, has disrupted interpersonal communications, because now we can do it all digitally from the freedom of basically our mobile devices. So when we're looking at building portfolios, what we want to focus on is where is the economy? Despite who the president is or isn't, despite what Congress is doing or what the world is doing from a governmental standpoint, where do we see kind of the impacts of disruptive technologies over the next, let's say, 5 years? And if you look here, you can kind of see the orange kind of estimates the high estimate in trillions of dollars of basically revenue, and the blue is the low estimate. So if you look at the Internet of Things, it's estimated on the high end to deliver about $11 trillion by 2025, and about $4 trillion on the conservative side. Mobile internet in itself is second, 10.8 and 3.7. Automation of knowledge work, so that's a little bit more of AI, coming in third, with cloud technology. And it depends. So cloud technology is going to absolutely be drastically affected based off of how much the Internet of Things really starts to evolve. Advanced robotics, that can be either industrial or medical. And then all the way down to 3D printing, which doesn't have that big of an impact now because of the high startup cost to actually acquire these printers. But as technology evolves, that generally brings down the price of the technology. So over the next 10 years, that may actually be a much more disruptive portion of the economy with regards to manufacturing devices. So this is kind of how it looks right now as far as expected to be in 2025. And when we look at the overall portfolio of Focus Equity, one thing that I do want to point out, and I'll get a little bit into it a little bit later, is trying to formulate a portfolio that maps where we want to be over the next 5 years. Because as we know, stocks don't wait for something to happen, they price things in ahead of time. So that's something important. So back in the old days, I remember in the early 90s when I had my first computer. It was actually Al's first computer that was just at the house. You had a computer, it dialed into a modem, that took a few minutes, and then the modem then eventually connected to the internet. And back then, you had very limited browsing. If anybody remembers Ask Jeeves, that was really popular before Google search really took hold. But that was back in the old days. And something that's also disrupting the investment market is actually ETFs. So you can see an increase of ETFs or exchange traded funds, so broad-based funds that own a basket of things versus actively managed mutual funds. So mutual funds were really a thing of the past where you could get broad exposure but a little bit higher fees. ETFs came in at a much lower pricing point, still have fees, and give you broad exposure. The problem that we see is, if we want to be taking equity exposure, we want to own the individual names. We think that that gives us the best bang for our client's buck. And obviously, there's no added fees when you purchase individual stocks on top of the management. So one thing to point out is, and this is kind of gets back to like the dinosaur analogy of corporations, is that today's companies are not going to be tomorrow's companies. So in 1964, what this looks at is the average length of time a company remained in the S&P 500. And at that time in 1964, it was about 33 years. So think of some of the older companies and how long they've been in the S&P 500. Some of those companies definitely are not in there now, but the average time that they were in the S&P 500 was about 33 years. Now, fast forward to 2016, it was only 24 years. In 2027, it's forecasted to be just under 12 years. So at that current churn rate, it's forecasted that the fully half of the S&P 500 or 250 of the 500 will be replaced over the next decade. Why? Because of disruptive technologies, because of changes in the economy. And this is clearly evidence, just going back to 1964, that unless those companies are continuously reinvesting their capital for the next 5 or 10 years, whether that's product simplicity or product innovation or ease of consumer access, those companies will not be the titans of what they were, let's say, 10 years ago. So where is the earnings growth, right? So price of securities are driven by earnings. And what I want to point out is kind of where that focus equity portfolio is allocated right now. Well, right now we've got about 35% or so allocated to information technology. Another 25% or so to consumer discretionaries. Another 15% or so is allocated to communication services. Fourth is healthcare. That's about another 15%. Financials is a little bit smaller at about 7%. And then industrial materials and a little bit in real estate, all around 5% each, with a minor position, less than 1% in energy and less than 1% in utilities overall. But the reason why we do this is because where we see earnings going over the next, like I said, over the next 5 or 10 or 15 years. And when you look at this chart, it kind of maps that out. And you can see the blue is over the next 15 years. The orange is over the next 10 years. The yellow is over the next 5. And the 3-year growth is in gray. You can see a large majority of expected earnings growth is going to come from consumer discretionary spending, specifically over the next 10 years. But also, second place is going to be over the next 10 years is going to be information technology as well as healthcare. And then they do see some changes over the next 3 years in financials, primarily due to blockchain technology and ease of access to transactions, not only here in the United States, but also globally. So when we build out portfolios, we want to make sure that they're aligned with where the earnings are expected to be growing over the next 3 to 15 years so that our clients can be well positioned to take advantage of where the markets are expected to take us. So here's about 6 different emerging technology trends that we see. Number 1 is artificial technology. That can be divided into autonomous driving, smart robots, virtual assistants, drones, as well as 3D printing. A second one, which I think is going to be really big, is blockchain for data security, IoT platforms, smart contracts, money transfers, digital IDs, supply chain management, food safety and tracing foodborne illnesses. Blockchain is going to be really big from a ledger standpoint, maybe not necessarily from a token standpoint, but definitely from a technology standpoint. Third is cloud computing. So cloud computing is data storage. The more of Internet of Things that we have and that are actively involved in our daily life, the more storage that we require. It's also going to be very important for national security and advancements in school classrooms, and as well as efficiencies in physician-patient files so that they're talking to each other. Everything can be stored in one place. Cloud computing is going to be very powerful. the fourth, which is going to be more impactful over the next, let's say, 10 or 15 years, is the health of our society, not just in the United States, but also around the world, which is biotechnology. So that's biochips, different vaccines, that's pretty prevalent right now, pest-resistant crops, plant and animal breeding, biofuels, as well as pharmaceuticals. Another one that's been talked about a lot over the last, let's say, 12 months or so is 5G connectivity. So 5G is going to be highly important in high-speed mobile networks as we're accessing more things on the internet, entertainment and multimedia sharing and file transferring. Our homes are becoming smarter farming, logistics shipping, smart cities, healthcare applications, autonomous driving as well with 5G, and then security and surveillance. And then the last one to protect all of those things is cybersecurity. So that's cyber crime prevention, AI security, which is artificial intelligence security, public transit safety, electricity grid safety, and lastly, which everyone has a personal connection to, which is our own personal data security. So these are the 6 emerging technology trends that we see over the next 5 or 10 years are going to become even more prevalent, specifically with the digital transformation that COVID is really forcing us into due to the pandemic. So let's talk about blockchain technology. And blockchain technology, I just have to make this very clear, is not Bitcoin. Blockchain is not Bitcoin. So blockchain is technology that allows Bitcoin itself to work. And this technology has many different applications just beyond exchanging virtual currencies. So what blockchain is basically a decentralized and a shared digital ledger, pluses and minuses, like an old accounting ledger. And it's kept and validated simultaneously by a large number of network computers. And the core innovation of blockchain is what we call digital trust. That is provable, it is intrinsic to a system without reliance on an external authority. So what I want you to think of blockchain as is right now, if we're going to purchase something, we have to use an intermediary. So an intermediary may be, the bank, it may be a credit card company. And what happens every time we swipe our card or purchase something online, whether it's PayPal or one of those banking services, they're actually the intermediary and the external authority verifying that we have that data or that amount of money within our own system. And what's different about blockchain is it doesn't rely on an external authority because of the checks and balances within the actual digital ledger. So each computer that's in the network is known as a node and has financial incentive to participate in the network in the form of some form of cryptocurrency, which a lot of them would be like Bitcoin or Ethereum, where they are getting paid to verify these transactions, and it's all used by an algorithm. And industry analysts, which I think is really fascinating, forecast that blockchain market growth to be somewhere close to about an 80% compound annual growth rate from 2019 to 2023, meaning more corporations, more institutions are going to start enabling blockchain within their own industries to, one, cut out the middleman, but also to provide more efficiencies. So we think blockchain is going to be an absolute huge disruptive technology. And when we look at blockchain, within that underlying portfolio, there are names like, Visa, PayPal, Microsoft, within that individual portfolio that are actually seeing exposure as they're making those changes inside of their companies to provide ease of service to the consumer. The next one is AI and robotics. So this kind of gives the projected growth, and it's projected to grow about 8 times in the next 5 years. So that's AI software, specifically in this chart, where you can see back in 2016, it wasn't that large. And over the next 5 years, it's expected to grow tremendously. And when we look at AI and robotics, it's not just like a company like Boston Scientific, which is a heavily invested in robotics, which we have inside the portfolio, at least as of the current day. But it's also the chips that are going in to a lot of these devices that are going to make AI actually possible. So some of those companies could be like an NXP semiconductor, which is actually located in the portfolio. And NXP semiconductors they basically create chips that power automotive, mobile, communicative infrastructure, smart cities, smart homes, as well as smart industrial infrastructures that are going to make it more efficient to be able to utilize the technology to deliver AI type of results in a more meaningful manner over the next 5 to 10 years. So think of this, and this kind of gets back to disruptive technologies and what the consumer actually expects. So the past is when you just wanted a fast, tasty treat. Now, not in the too distant future, you're going to get a tasty treat that looks a lot similar to this. And you've already started to see some of those trends actually exhibit themselves just over the last few years. But what's interesting is this guy. So momentum machines are what we call the Big Mac killer. So they have actually developed machines or robots that can produce over 400 burgers in an hour. Now, some of you may be thinking, well, what is that going to do to the workforce? And you're absolutely correct. But you have to think of, do you feel bad for the guy who bought the last horse when the Model T came out from Ford? And we don't think of that ways because our economies evolve, new jobs open up, and that's how we view this. But just as an example, when we're talking about that burger, AI and disruptive machinery or momentum machines are going to really start transforming how we do business. And it's those corporations that utilize that technology that are going to be able to drive higher earnings from lowering production costs. So, threats to disruptive technologies and why cybersecurity really does matter. So the World Economic Forum ranks cyber attacks as the 5th most likely global risk for 2019. So as of last year, it's the 5th highest risk in the world as far as global risks, which is cyber attacks. Cybersecurity Ventures predicts cybercrime damages will cost the world $6 trillion annually by 2021. And up to $3 trillion, which is up from $3 trillion in 2015. So it has the ability to cost $6 trillion in damages, or you can look at it another way, that's $6 trillion of opportunity for cybersecurity firms to try and protect against some of these threats. The global cybersecurity market is set to grow from its current market value of about $120 billion to over $300 billion by 2024. And approximately 4 billion people are currently using the internet today and need some form of cyber protection. This is a possible human attack surface equal to 58% of the world's population. So with 4 billion people actively using the internet on a daily basis, that's a large target market for some of these cyber criminals to come in, which makes cybersecurity all that more important. And 336,000 ransomware attacks have occurred between January of 19 and March of 19. So just in that one quarter, there were 336,000 ransomware attacks. And I'm sure all of us know someone who has clicked on a bad email and then they've had to either take their computers down to Geek Squad or just get a brand new computer. So here at Whalen Financial, we have to invest a tremendous amount of money in making sure that our data for our clients is safe on a minute-by-minute basis, consistently updating not only our passkeys, but also our encryption keys to make sure that our clients' data is as safe as practically possible. But that increase was 195% increase from the Q4 of 2018, and we still see that trend continuing. So this is exactly why cybersecurity matters. And remember, I talked about the other 50% of the portfolio. We own names like Proofpoint and CrowdStrike, which, Proofpoint is a cybersecurity company that basically checks inbound email security, outbound data loss prevention, as well as just digital infrastructure risk. And same for CrowdStrike. So we do have positions in the portfolio that are really trying to gear towards the increase of demand over the next at least over the next 5 years. And like I said in the beginning, this is one big area that I think a lot of portfolios are really underestimating. It always doesn't deliver value immediately, but I think it's going to be more impactful as time goes on. And if you join the webinar, which is August 26th, where we talk about thinking further, we've got this amazing medical engineer and as well as a physician that talk about kind of the advancements in healthcare technology, where it goes from addressing the issues once you get to the hospital to more of an environment of preventing the issues before you get to the hospital. So we'll go into more detail on that on the August 26th webinar. But the reasons to be bullish on biotechnology and why we have about 5 or 6 different companies that are outside of that 50% of the portfolio inside of the focus equity portfolio is because drug spending is absolutely going to continue to increase. Our population, not only around the globe, but specifically in the United States, is not getting any younger. And drug spending, as well as health of individual peoples, is going to be at the forefront of trying to address some of those issues that we have in overall society with regards to health. There's a tremendous amount of M&A going on in biopharmaceuticals, where companies are acquiring each other as well as merging to use the resources of 2 individual companies into one to try and make a drug a lot more efficient or better for the overall population. And what's happening with COVID is evident. There is a faster FDA approval process now. This is the fastest that we've gotten to a potential vaccine or a phase 3 trial study in modern history. And just because COVID is gone eventually doesn't mean that that fast track to FDA approval is going to stop completely. Like I said, once things really start to become prevalent and are embedded in society, it's hard to go backwards. So we think that the faster FDA approval system is going to be more beneficial to these biotechnology companies, as well as tax reform. They're getting a lot more benefits, at least now, to take the risk to produce various drugs and the capital to produce various drugs. And that helps those companies take more risk because they know that they are getting some form of a tax reform break to develop some of these drugs that are going to make meaningful impacts across society. So with regards to biotechnology, I just wanted to name off a couple of the names that we do actually own inside of that focus equity portfolio. So the first one is a BioMarin Pharma. So BioMarin Pharma is a genotherapy company focusing on sequencing the human genes. Why is that important? Because the faster we can do that, the more we know about the genes of humans, the easier it is to not only detect, but also trace and treat various ailments that come with being a human being. The next one is Vertex Pharma. So Vertex Pharma really focuses on cystic fibrosis as well as type 1 diabetes, 2 of the biggest diseases that we actually have here locally in the United States. GW Pharma is another one. So we're not really heavy into anything with regards to cannabis or investing in marijuana. We just don't see a tremendous amount of opportunity in that space on an exchange scale because it's not legal in the United States, and we don't really like investing in Canada or Canadian exchange companies. But GW Pharma is actually a US-based company that is using cannabinoids or plant-derived therapeutics. So we do think from a therapeutic standpoint, there are some opportunities over the next 5 or 10 years that can be developed using some of the things because of the looser regulations on cannabinoids in general. Another one that I think is really interesting is Guardant Health. So they're actually developing blood tests for early detection in high-risk populations, as well as reoccurrence monitoring on cancer survivors. So we talked about that just a few seconds ago, where the future of healthcare is going to be actually in the idea of preventing you from going to the hospital versus once you get there, actually treating what you have already. So a company like Guardant Health is developing massive amounts of new technology around blood tests for early detection. And then Dexcom, to round off the biotech portion of the focus equity portfolio, is there for glucose monitoring systems. So they develop these glucose monitoring systems. We know type 2 diabetes is a tremendous problem with the amount of people in this country that are overweight or even obese. It's a very large amount of the population, and that company is taking advantage by providing the devices for testing. BioMarin, Vertex, GW Pharma, Guardant Health, and Dexcom all round out portions of the biotech portion of the portfolio because we do see it as an increasing portion of not only GDP in the country, but also betterment for the health of society over the next 5 to 10 years. So just to give an example of companies that are using AI and the cloud in innovative ways, if you weren't lucky enough to get tickets to last year's Masters, artificial intelligence and cloud computing created a digital experience that really captured the essence of the real tournament. So what they did is they created round of 3 minutes. And what the round of 3 minutes did is it was a highlight reel created entirely by AI and cloud computing. So what they used was IBM's Watson AI robot. And what it did is it analyzed the excitement level, the crowd noises, the gestures, the emotions, the speech of over 20,000 shots from 5,000 different holes. And it determined the most exciting clips and created a 3-minute highlight reel for every round by every player. So first thing that we like to talk about is time efficiency. So if a human were to do this, a human would spend countless hours to sift through clips and edit them into something that's actually usable. And secondly, if we look at other than time efficiency, it's extremely cost effective. So think of Augusta National only pays for what it consumes on the IBM cloud, rather than its own servers that lie dormant for 51 weeks out of the year, allowing for peaks and demands such as the 2019 Masters Tournament weekend. So by utilizing cloud technology or offshoring that to a different corporation, not only is it time efficient, but it's also cost effective, and it happens almost instantaneously versus countless hours of having to go through it. So I just thought that was a really interesting example of cloud computing. And with regards to cloud computing, before we get into 5G, I just wanted to kind of talk about, a company like NVIDIA, which makes chips that go in cloud server data centers. They also make chips for gaming. So I think esports is absolutely here to stay. It's a pretty large part of the overall economy now, specifically for the younger generation, which is only getting larger and larger as far as percentage size of the population. But NVIDIA also provides the chips that go into blockchain technology for mining for things like cryptocurrencies. AMD, regarding 5G. So we think 5G is the next evolutionary process to allow for faster data speeds for connectivity to allow us to take that next step into what we call the digital landscape of the future. And 5G is basically the 5th generation of wireless technology. It is the new mobile wireless system that is expected to really transform the world. And the reason is because 5G runs on a much higher frequency than 4G LTE, which was the fastest at the time. A quick joke about this, and you may not laugh, but I laugh sometimes about it, is I was talking to my uncle. If you remember, there was all of these wars about word wars about what we're going to name the next technology of high frequency wireless connectivity. And we came up with the name Infinigy, which would be, the fastest gigabyte technology. And we looked to see if we could trademark that name, and it was already taken. So my uncle, I'm sorry that ticket to fortune is not available. But to get back to it, the 5G technology, it basically, what it does is it really has a faster upload as well as download speeds. It reduces the lag time, greater network capacity to handle a significant higher number of connected devices. So in 2018, if you look back to 2018, 5G became a reality with some wireless carriers launching it in certain test cities. So if you think of like a company like Verizon, where they started in certain areas of the country to test out 5G. But the forecast, the number of mobile 5G connections worldwide from just next year to 2025 is looking to expect from 100 million to over 1.1 billion. And that's really big to allow the Internet of Things to really start to engulf the economy, to one, make us more productive, two, make it more interactive, and make sure that we can do it at a faster pace and more reliable speed in the future. So one company in particular stands out to me, which is AMD. So they really have a big part in playing for 5G data centers. And so maybe not just the fiber portion of it, which a lot of people look at in various equity positions. We like to look at it in the data centers, because you have to have those data centers in order to run the 5G technology. Another area that a lot of people don't think of is a company like Crown Castle, which is also in the portfolio. So Crown Castle is the largest provider of shared communication infrastructure in the United States. So they own over 40,000 cell towers. They own 70,000 route miles of fiber that is supporting small cells as well as fiber solution. So that's another outside of the box way to play those things. And remember, I'm not recommending you to go out and purchase any of these things. I'm just trying to show you within the focus equity portfolio some of the names that align with the disruptive technologies over the next 10 years. But that's kind of today's presentation. And before I let everybody go, I just wanted to kind of briefly recap those areas where we see growth over the next 10 years. Definitely in information technology, extremely important to focus in biotech as well as 5G. We do think blockchain is going to be disruptive over the next 10 and 15 years. And when we build out portfolios, we want to make sure that we don't own just the biggest companies in the US. We also own those large companies that are providing investments for the next 5 and 10 years. Because if we can think towards the future, it's going to hopefully be a better future 5 years from now than it is today. And, I've got a saying that says, if you can't see a positive future outcome, you're never going to stay in your investments long enough to ever achieve one. So when we build these portfolios for clients, it's important to include those disruptive technologies, even if they don't make up a large percentage of the portfolio, meaning 10% of the portfolio in one 5G stock. It does make a significant difference if you can get in earlier rather than later. So I hope you enjoyed it. If you have absolutely any questions, make sure you give us a call or shoot me an email. I'd love to talk to you about it. Or if you have questions about the focus equity portfolio, I'd be happy to answer those as well. So thanks for taking the time. I really hope you enjoyed it. And I look forward to talking to you next month at the halftime report, which is going to be August the 12th. And then following up with that is Thinking Further, which I'm really excited about, which is August 26th. So thanks everybody for joining. I hope you have a great day and stay healthy. And I'll talk to you soon. Thanks.